friends, welcome to the Nirmal. I'm Piyush Jain, and today we are going to talk about gold. As you know, it's an asset class everybody loves in India. Gold, silver, whether it's a function, it's for investments, it's adored, loved by the investor community, by households. Even the central banks have been buying gold almost most of the quarters, as we see the Indian central bank. So perhaps everybody in India right now is buying gold. Now the question is, which everybody keeps asking every month, is the prices continue to go up. We are seeing a lot of volatility in the global markets since last year, though most of the asset classes are going up. But still, the question comes in: what do we have to do? Are the gold prices continue to actually move up? How's the sort of world reacting? How are the funds performing? What actually the other regions are doing in terms of gold? What's happening there? There are so many questions which people like us in India really need to get an answer. And for getting those answers, we need to actually call upon a global expert and industry veteran. Let me now introduce the Global Head of Research, World Gold Council, Mr. Juan Carlos Artigas. Mr. Juan, welcome to the show.
Thank you so much for having me today.
Mr. Juan, I'll start from the perspective of gold as an asset class. We have seen that overall, on a sort of 6-month basis, gold basically has delivered about 5 to 6% returns. When you look at the last quarter, perhaps we have moved here and there. What's your view from the perspective of what's happening in gold?
Well, I think that it has been a very interesting first half. Gold has, as you mentioned, produced very robust returns, and it has outperformed most major asset classes except for stocks. And it actually comes after a year where gold had one of the few positive returns amongst other asset classes, right? So even though it had, was slightly above the previous year, so it was slightly higher, it was still positive in a year where stocks and bonds were falling significantly. So 2023, it was the first half of 2023 was very interesting, in part because of that continued support. And one of the things that we look at is the fact that gold does not have only one source of demand. It has multiple sources of demand. And the interaction of those sources of demand, whether it is for jewelry, investment, or central bank purchasing, for example, can actually help explain the behavior of the asset class. Recently we published our outlook where we are describing, some of those drivers. And one of the things that we found in particular for the first half is that gold was supported by geopolitical and event risk, like the mini crisis that happened in March in that time in the US. Central bank buy-in, because central banks have continued to be net buyers of gold, so that's a second reason. But also because interest rates were relatively stable, so that was a positive for gold. It was not, dragging down so much gold, and also because the dollar was also, kind of moving, relatively sideways, actually, slightly, not necessarily creating headwinds for gold.
Right. So from that perspective, when I look at the data of the central banks and when I try to correlate that interest rates have been moving up from the second half of the last year, we have seen European Central Bank continue to actually move up, chase basically the inflation target, which remains low. US again bank basically is chasing a low inflation target. We actually are seeing a pause from the Indian Central Bank, but largely Asian central banks are raising interest rates. South American central banks are raising interest rates. From this context, why basically, what is the underlying reason for large purchases or continuous purchases by the central banks, according to you?
Well, central banks are buying gold for many reasons. In fact, we published our 6th annual central bank gold reserve survey a couple of months ago. And it was very interesting to see what central banks are thinking behind the hard data that we see published through the IMF and their own websites, right? And oftentimes they buy it because it's an asset, a highly liquid, high quality asset that they can add to their reserves. It's a diversifier. It has also been part of central bank reserves for many years, and it doesn't have any counterparty risk, meaning it's unlike bonds issued by other nations. Gold is a real asset, and that balance and that diversification can be quite useful for central banks. Now, also geopolitics and many other reasons come into play. There's many varied reasons that have supported this trend for years now, for more than a decade, where central banks have been net buyers. But in the past couple of years, in particular last year, and they have continued as well. In a relatively strong form this year, continued with the net purchases.
Right. Any particular observation which you want to share from the last quarter data or the June month data or the last quarter data? Because I was looking at the data, flipping through it, and I observed that China, India, they continue to be net buyers continuously. You saw actually big purchases being made by Singapore Central Bank. Any sort of observations where you actually are looking at some peculiar common data points from particular central banks?
Yeah, so and actually, well, we are going to be publishing our gold demand trends for the second quarter at the beginning of August, and we will have a better understanding of all the trends. For now, there's partial data that has been reported through IMF holdings, and the second quarter actually looks a little bit more mixed, partly because there were some sales of gold happening in Turkey, which was a very individual, let's say, idiosyncratic dynamics that were happening in the country, and part of it because it was meeting local demand. So the central bank was selling gold to meet local demand that was quite strong, like individual demand and so on and so forth. But as you mentioned, generally speaking, we continue to see net buying from other countries like China or India and kind of like various others that have had support for gold and have been adding gold for quite some time now as means to diversify and strengthen their reserves. And by the way, one of the things that you were talking about, which I think is quite interesting, is the fact that while interest rates have continued to go up, gold has held up, and that's something that puzzles investors oftentimes. Like, why is this happening? Because it is seen that when interest rates go up, gold may tend to pull back or have a harder time, rising in price. And part of the reason is because, as our outlook shows in our analysis, by now gold is not necessarily responding to policy rates, so to policy action, but actual bond yields that carry forward expectations of what the Fed and other central banks are going to be doing. And most of them are nearing the end of their tightening cycles. So, they are not starting. They have been rising, as I mentioned last year in particular, a lot. And by now they are getting closer. Even if the Fed rises one more time, even if they were to rise 50 basis points, it is still within expectations, equally for the European Central Bank and the Bank of England. So that basically means that gold naturally, as any other asset, is responding to the expectations of what may happen. And some of those have already been priced into bond yields as we see them.
So are you expecting cut in interest rates? Like, we can keep debating 2 quarters, 3 quarters, 4 quarters down the line when, but are you expecting that we actually could be seeing far higher gold prices? Because the bond yields, as you just said, the market actually knows it, so it is pricing ahead of expectations. But are you expecting the gold prices to rally from here?
Well, we don't forecast the price of gold directly. What we have created is a tool, a valuation tool that is called Quorum, that helps investors understand how gold may react to different macroeconomic scenarios. Now, in our outlook, we looked at 3 different scenarios. One, which is consensus expectation. So if you look at what economists are predicting at the moment, generally speaking, is a mild contraction in the US towards the end of the year and fairly low growth in developed markets, for example. And as we mentioned before, kind of like continued hikes, but not as much. I mean, we're kind of like getting close to the end of the tightening cycle and various other data points. Now, from that construct, we expect that macroeconomic scenario is still going to be somewhat supportive of gold. So gold may not necessarily break out or move significantly up in that particular scenario, but it is still being held up by the environment. Now, if a recession were to happen, so if the economic conditions were to deteriorate, and we may see even event risk increasing or some sort of significant deceleration in developed markets, those environments tend to be far more supportive of gold. Historically, gold has tended to perform quite strongly in periods of financial risk and recession, and therefore, in that scenario, we would expect gold to react more positively. Now, conversely, it is also important to understand that, of course, if central banks end up increasing interest rates far more than expected, or if we end up in a soft landing, those conditions may be a bit more challenging for gold. But our analysis shows that given the strong performance that gold has had so far this year, and the fact that there's still quite a bit of appetite for gold in different corners of the market, including central banks, that environment, while more challenging for gold, may still kind of like, not be, the downside may be somewhat limited.
Right. That's good to know. From that perspective, what's your assessment of how the ETFs are behaving? We always know the ETFs is hot money. They normally react to market movements, and of late we have seen some selling happening by ETFs, and that is more like an exchange demand, whereas central banks, we talk about a physical demand. But on the ETFs, what's your assessment?
Yeah, and actually, we track about 100 plus gold-backed ETFs around the world, and these funds are actually backed by physical gold, so they do result in physical demand for gold. But what you're bringing up is an interesting point, because ETFs can be tracked on a daily basis, right? So they can give you a little bit of a barometer real time of one portion of the market is doing. We, on a quarterly basis, release our gold demand trends report, which is more comprehensive. It looks at all aspects of demand, and then you form the complete picture for gold that is both a consumer good as well as an investment. But going back to your point, in the first half of the year, we did see net outflows from gold-backed ETFs. A good portion of those were coming from European funds, and that's because European central banks started their tightening cycle later. So interest rates started to increase later in Europe, and they started to have pressure on gold. In fact, actually, at the beginning of the year was the first time that real interest rates were positive in Germany for many, 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 many years, right? So that, clearly created headwinds for gold in the region, and therefore, started to put pressure on gold. But we still see during that time, for a good portion of the year, net inflows from North American funds, right? So it's not just the one asset class; it's a combination of. Now, the last year, the last month, partly because of a bit more hawkish. The more hawkish tone by the Fed, and maybe because geopolitical risk is not perhaps as high as it was in 2022, we continue to see a bit of outflows. Now, as you mentioned, it is very normal for investors to come in and out of the market sometimes. And these funds, especially if there were a period of risk, another event risk as it happened in March, you may see a larger reaction. Our perspective is that this helps the market be in balance, because it's not just one part of demand. So if there's outflows coming from ETFs, you may still see interest in other sectors of the market that help the gold price be supported.
Right, and that's interesting. From that perspective, perhaps how are you looking at the sort of seasonality in terms of demand from India? I'm now actually bringing the conversation to India, our domestic purpose. How's the demand looking to you? What's the data telling you? We have
That's
observed that it's almost a seasonal thing that around this time, the discounts to the global price in Indian markets, the local price, they start narrowing down. Last year also happened. This year also is happening. So, what's your observation?
Yeah, you're absolutely right. In fact, it's interesting because there is a lot of seasonality in demand in India and also, for example, in China, which are both really important gold markets. Now, that not always translates to gold price seasonality, but I'll talk about that in a second. But as you mentioned, it is true that kind of like, the second quarter and kind of like the beginning of the third quarter, basically the summer, tends to be seasonally weaker in countries like India and China as well. So you do see those that effect that of narrowing of premiums. Right now, this is exactly the time when the monsoon is happening and so on and so forth. But that usually yields to a much stronger late Q3, early Q4, after the harvest season, after the monsoon season is over, and the harvest season comes in, and many of the a lot of people are using the income as savings, and also the wedding season kicks off, and many other things, right? So you start to see it's very common to see this pattern. Now, what is interesting for the gold price itself, as I mentioned, because India and China, while demand there may be seasonal, they not always exactly coincide with each other. And also you have investment demand and central bank demand, right? So in terms of price, what we have seen as well is that the summer may not necessarily be a period where you have a lot of activity, but ahead of the wedding season in India and various other things, investors tend to position towards the end of August, early September, and you do see a little bit of movement in gold, interestingly, because of the confluence of the fact that after the summer, investors come back into the market, the Indian consumers and Indian investors start to come into the market. But yeah, generally, it's a normal period during the monsoon and summer seasons for demand to be a bit quieter.
The seasonal Indian demand, and towards the fourth quarter of this calendar year, and then the first quarter of the next calendar year from the China perspective, are these two quarters something which provide support to the gold prices?
They do. Definitely, it's important to have, like, consumer demand is important to the health of the gold market. It's not just about investment demand. And gold is definitely an adornment. And while in India, jewelry is bought both for purposes of wearing it and the beauty of gold itself, it is also partly as means to save and to transfer wealth from generations and so on and so forth. Clearly the last part of the third quarter and the beginning of the fourth quarter tend to be quite strong, and they do provide support for gold. Now, again, it's one of the components. There's various others, but we have seen positioning ahead of that towards the end of the summer and September, because investors are expecting some of this demand to happen, as well. For example, in China, as you mentioned, with the Chinese New Year. Now, it is from our perspective right now, like India. The Indian economy looks healthier, and that's a positive thing. They're in slightly different cycle. China started to rebound, but not as much as expected. But the central bank has cut rates, and they have, they will likely provide potential stimulus and so on and so forth, which may provide further support. So that's something that we're watching for. But generally speaking, the seasonal pattern tends to be an important component of the overall behavior of gold.
Right. One question I wanted to ask you: we of late have seen the trading volumes dip on the exchanges. If I was just looking the last month data from the perspective of trading, is that something primarily because it's more about Europe driven, or there is I would say a bit of risk of trade happening in gold, or the prices right now almost trading in a narrow range? Like I'm putting different sides to see it, but what's your thinking? What's happening on the exchanges?
Yeah, look, it's interesting because it is true that exchanges tend to be more, Western driven to a degree. I mean, COMEX is a large one, but you also have volumes in the OTC market. We publish all this data on a monthly basis. The LBMA through Nasdaq produces statistics on over-the-counter trading in gold, plus, clearly, COMEX positioning, which is in the US. Interestingly enough, the summer as well tends to start to slow down a bit, from a seasonal perspective. So that's an interesting component. But we have seen some interesting patterns ahead of the past couple of months, where, in particular, for example, options trading start to increase a bit, partly because people are perhaps expecting more of, looking for that additional move in gold, whether it is one move or another. But yeah, I mean, primarily those exchanges, while of course there's MCX in India, it contributes a little bit more to the total global liquidity compared to what you may see in Western markets or even on the Shanghai Gold Exchange in China.
Right, and perhaps the last question. I'm not sure whether you're going to answer it, but I'm just asking you. So in India, what happens? People look both at gold and silver. Gold, as you know, everybody likes to buy for all occasions, investment, celebration, fun, gifts. Like you name the reason, and they'll buy gold for it. But do you have also an opinion on the gold silver ratio? Like the two, they normally move together. I'm just trying to ask you if you do have an opinion on that.
Yeah, no, of course, happy to answer that. Look, there is nothing fundamental about the ratio between gold and silver. So when gold and silver were standards for coinage, so when they were used as coins, and there was, many, actually I would say, several centuries ago, a bimetal standard where you could basically exchange silver for gold. Naturally, there was going to be kind of like a ratio between the two, right? But that broke a really long time ago. Now there are some similarities in demand in between gold and silver, but they are not that large. The gold's demand is far more diverse. So you have the consumer side in terms of jewelry and technology, high-end electronics. You have the investment side, that is quite strong, and then you have central bank demand. For silver, demand is still far more driven by electronics and industrial uses. So there is, as you mentioned, definitely some purchases for both jewelry and investment, but not to the same degree. And certainly central banks not buy silver for their reserves in the way that they buy gold. So the dynamics are different, right? So I think that this ratio is more something that people look for, and maybe because of the positioning starts to move, somewhat in a pattern that we feel that we recognize. But the reality is that the fundamentals are not there. And if you look at in detail, you would see that the correlation between gold and silver tends to break down, especially in periods of risks. So when there's a recession or when there's an event risk or something, gold is going to break out significantly more, and not necessarily silver. So the correlation follows the business cycle. So when the economy is doing well, they start to correlate a little bit more.
Silver also
The
does well.
economy is not doing as well. That's when you see gold increasing more.
So from that perspective, is silver right now inexpensive, or we can't say like that? It's more about where the gold is focused right now.
Yeah, we don't focus so much on perhaps a comparison from that perspective. What we tell investors and what we believe based on our analysis and is that gold is a truly strategic asset. So naturally, many investors may use other assets, including silver, more tactically. But we believe that gold's role in a portfolio is strategic, meaning it's for the long term and is the one that is going to provide very effective diversification. And of course, investors will have many other assets in their portfolio that they can use in different ways and potentially find some tactical value for them. But I think that the difference here is that gold is the mainstream strategic asset.
Absolutely, and is an asset which the central banks of the countries actually like to hold, and they consider it as a part of their foreign currency reserves. So perhaps Gold is looking quite interesting. That perhaps is one of the takeaways from our conversation. We looked at the data from different perspectives, and perhaps the second half of the calendar year should be interesting. Mr. Juan, thanks a lot for coming on our show and giving us all the insights on the gold. And we look forward to reading your report, which is going to come in the August, and we'll stay in touch.
Thank you so much for having me. It was a pleasure talking to you.
And with that, dear viewers, it's a wrap on the show. Hope you enjoyed this conversation.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.